Hello, Pace. Good turnaround Tuesday to everybody. Hi, Ziggy. I'll oil my chair later. Bando, nice to meet you. Hi, Patrick. How are you? Everyone doing okay? So turnaround Tuesday, off the gun. I don't see a lot of reversals I want to play. For example, we haven't made a new high in the Dixie yet. I'm looking for 5.5 or so to be taken out. Everyone with me? Some people may say this could be a double top. It could be. I still want to see these levels taken out. They may have by a pip or so. High here is 95.15. High on this candle, 15. So I'd say there's at least one buy stop above 515 right now. People that are short have hope that we might get a double top. I think even if we do get a pullback, a double top is a hope double top. In my view, give me a Y if you're with me. Sometimes these are the best trades where the market gives people hope that top pickers, by not taking out the stop right away, pulls back a little bit and more stops build and accumulate over this level before the algos go for the liquidity and look to sell into the buy stops after they're elected. Okay, so yesterday we have a experiment going on Euro Pound, and we're testing out the thesis that confirmed highs, and it was only a confirmed high on the 1 hour chart, will not be the high of the move. This was on the BOE. So we were talking about a scale in type trade where you buy a little at 50%. We're now sitting at the 61.8. Last buy would be at 78.6. Maybe a turnaround Tuesday happens here. Still my contention that we're going to take out this high before we take out this low. But if we do, you have to get out of the way down here. If they do it, it's usually better when the market corrects more in time than in price. This is getting pretty deep. It would have been better if it held halfway back. But fibs are fibs. In fact, fibs are not lies. They're numbers. So we'll see how it reacts off of this. Also looking at US dollar yen, for it being a potentially failing rally here. Blake pointed out yesterday how we went to major resistance and reversed. This could end up being a failing rally up here. So for turnaround Tuesday, could be a decent short in here. You're wrong over the high of the day here. Everyone with me on that? And then I wanted to touch upon the metals, the precious, because we talked about this last week. I talked to Blake and said, well, you know, silver really had a nice heartbeat. It actually was outperforming gold on this rally. We pulled back into a natural zone at 1680. I tweeted out right in here, don't wait to buy silver and wait. I still think that this is just a normal pullback. I'm looking for higher levels here. I think that will close well above 17. We look at a little longer chart here, 4 hour. And we could head up towards 1780 or so if we have some type of equality with this and this. So silver's still looking good after it gave us a heartbeat. There's been a couple of pullbacks to buy. I don't think this pullback's any different. In fact, look at this one was pretty deep. This one's pretty shallow. So all the bears will have their stops over 1745 or so. I look for them to be elected. How are you, Raz and Forex Gal, Patrick? Everyone doing okay? So these are a few things that I'm monitoring that I wanted to point your eye out to. So be on the lookout. I still think the gold also, although not as strong as the silver, has the same type of pattern. Maybe not as much relative strength, and it's being contained by the 200 here on the 4 hour. I think that gold could make another move back towards maybe 1310. And even if you're a long-term bear, you could say this could be A, and I'm far from an Elliottian, and this could be B with a higher low here, and we could get C up here towards 1310 for a big short up there. But in the meantime, you know, the art of it is when, not if. So I'm still looking for higher gold prices. So if you're a bear looking for lower levels, I know a lot of bears are looking for 1220 or so down the road. I think you're going to have a better shorting opportunity here, probably after they take out all the bears over this high. That's why they call me, and I call myself, Forex Stop Hunter. So here's my quick lesson on knowing where the stops are. Okay, here's your lesson. People say, Dale, where are the stops? How do you know where they are? So all you have to do right now, everyone in the room, is imagine if you're short gold, where would you put your stop? Well, that's where everyone else's are as well. They're normally over obvious swing high points and swing. So if I'm long, where do I put my stops? Right. So that's where everyone's are. So you could look at the market that way and say, well, okay, where are the stops? And then which group of stops are going to be elected first? So it'll give you the bias on what side of the trade you want to take. That's my lesson for today. So although baseball season has ended, we have a little switcheroo by our manager, the manager of the team, Blake Morrow, and Steve is going to be next. He's on deck. He's in the on deck circle. You're very welcome, Forex Cal. So Steve, step up to the plate, buddy, and let's hear what you're seeing. Let's see what you're seeing. And I always look forward to Steve's analysis. It keeps me sane. So hi, Steve. How you doing today, my friend?
Good morning, man. I'm good. And Blake is going to be with us at the bottom of the hour in around 25 minutes from now. Yes.
Okay. Yeah. So we switched the batting lineup. You always put your big hitters in the cleanup spot. So I'm the leadoff hitter. You're second and third, and then we bring in, the power hitter.
Not really familiar with baseball, and the only reason I'm somewhat familiar is because I went to an American school in Greece. Otherwise, the Greek person is absolutely unfamiliar with the sport. Okay,
well, then let's talk about the javelin throw, or some type of the decathlon. Is that more up your alley? All right, buddy.
Football, actually, but I'm not talking about America.
What are you thinking here? The dollar threatening that high? Your view? I think it's. Go ahead.
First of all, Grega has said it before. Many times you shouldn't trust Monday moves. Okay. So, for example, we saw the dollar being weaker almost all over the board yesterday. And so far today, in the vast majority of the dollar pairs, we are already seeing the dollar reversing yesterday's move. Personally, having to do with the dollar thesis in general, nothing much has changed in my opinion, which means that I do believe that as long as we remain above 94.20, now, especially that we've cleared some, critical event risk, that we might be on our way to perhaps 96, which is the 38 point. I'm not sharing my screen, I think.
Yeah, I like that area.
Wait, let me show my screen.
Okay.
Okay, now I should be showing my screen. Okay, so nothing much has changed as long as we've managed to clear 94.20, and as long as the vast majority of the event risk we had is now behind us. Although having to do with event risk, so I don't mix up things, we have BOC's Polos speaking in I think about 4 hours from now. 4.5 hours from now, something like that. And we also have Yellen speaking later, although I don't expect anything from Yellen, that will jolt the market. I'm just, mentioning, because we don't have any other event risk left for today. We had the RBA yesterday. Nothing much happened, as people can see on the chart. But anyhow, I believe that
might be interesting to see what Janet says.
Now that she's definitely out of the job, you mean?
Huh?
Now
yeah, but I've heard she could stay as a governor if she wanted.
Oh yeah, it's not certain what she's going to do. Logic says that she's going to leave. Usually that's what
because you get paid big money to go back into the private sector.
Yes, plus it's a little bit weird being, the top woman in this specific situation in a body of people, and suddenly, having somebody above you. I mean, makes of a little bit weird dynamics. She would be useful for the Fed. There's no question about it. Yeah. But my thinking is that she's probably not going to stay. I mean, that's what I would expect. That she's gonna quit.
Okay.
Anyhow, it remains to be seen.
Yeah, doesn't matter.
Not really, to be honest, not really. Although her experience would be useful. Don't forget that the person that succeeds her is a lawyer, right?
Oh my God, Shakespeare wouldn't like that.
Yeah, not that economists have shown amazing ability to control things in the economy in the past, at least. Not in the central banks. Usually people that have a theoretical background end up in positions like the Fed. And in my opinion, it would be a lot more useful if people that have actually worked, on the field practically.
Maybe we'll see a lot more lawsuits coming out of the Fed.
We'll see what's going to happen. So anyhow, I think that there is no reason, as long as we remain above 94.20, and now especially that all the event risk is off, to be looking for the dollar to move lower. At least personally, I fully expect it to at least tag the 38.2, which is up there at almost 96. As Blake has mentioned in the next week's preview video that we upload every Sunday, the dollar does remain strong, but on the other hand, which makes for an interesting dynamic, the dollar is not strong all over the board. Okay, so its performance among different pairs are mixed, so there are better and worse opportunities out there. Obviously, one of the things that are moving today to the expected direction is the Euro USD. I mean, the Euro USD has been extremely technical. It gave us one of the most perfect head and shoulders formation we've ever seen. It then created a little bear flag, which came back to retest the neckline, and it's now resuming lower. As I've said plenty of times before we even got to craft the head and shoulders formation. For me, the level to watch is 114.50. That's the level I want to see tested, and I'm fully aware that the head and shoulders target is lower than that level, but personally I don't really care, because for me it's all about seeing what's going to happen from there. And if we break down from there, then we can discuss what the head and shoulders target is. But unless I see 114.50 break, I don't even care to see for deeper targets, because I consider that a very important level. I mean, if you look back, all this consolidation down here can be viewed as a channel, and that's going to be a retest of that area, and also of this horizontal support resistance area that has acted many times in the past, in a very predictable manner. So I really want to see what's going to happen down there. Okay, so it's definitely not moving fast, there's no question about it, but it is moving in the right direction. Now, on the other hand, Aussie and the Kiwi, seem to be, here's the Aussie, here's the Kiwi, both of them seem to be in some kind of recovery. There it is, that in my opinion should end quite fast for another push lower. Kiwi almost made it. I was looking at this area, the 69.70 area. The Aussie actually did make it, barely tagged the 77.40 area, and you know, I believe that, especially that now the RBA is out of the way, we're probably going to see another push lower towards. I have a nice confluence of supports at around 0.75. So more or less what I'm looking for next is that area. This area held very nicely because it was also the 61.8. But as I had said on the first rebound we had when we drew that, as long as the 77.40 area holds, there is absolutely, you know, no bullish scenario to build on Aussie. So you know, I kept looking lower, and you know, if we resume as we seem to be moving today, that might actually happen sooner rather than later. Now,
what would flip you to constructive Aussie? What level?
Not sure. I'll tell you what I mean by not sure. It also depends on the way that would unfold. You know what I mean? Would it be? I mean, would it be pushing higher in a slow manner? Would it be pushing higher in a, you know, in a very abrupt manner, and the dollar like plunging? So I'll tell you though, as a general rule, but that unless I see a break above this 0.79, I would be very hard to convince that Aussie is constructive. Very hard to convince.
Thank you, buddy.
Okay, no problem. Let's have a look at the USD yen, because the USD yen has been one of the most interesting. I remind you, guys and girls, Blake is going to be with us in 15 minutes. We just switched positions. It's more convenient for him. I'm sure I'm going to have plenty left for him. So the USD yen, yes, yesterday, actually Sunday night, at least European hours, Sunday night, the USD yen pushed decisively higher after, you know, very strong statements from Kuroda. In essence, he said that the BOJ is going to be conducting powerful easing more or less in an indefinite period of time, because the 2% inflation target is still far away and it's elusive. So, you know, having to do with statements, you can go stronger than that. I mean, in actually photographing how your monetary policy is going to be. So we got that really big reaction, I mean, for a Sunday night. And then during the rest of the day, the market actually retraced like all the gains and actually closed negative. So that yesterday was a very, very bearish candle. But on the other hand, we never managed to break below this potential ascending wedge that we're monitoring here. And I'm saying potential because if, let's say, today or tomorrow, like we accelerate higher and we penetrate above it, obviously this was something different, but it now, like, you know, the trend lines now work very nicely to make it look like an ascending wedge. So yesterday we closed at the support. Today we're pushing higher once again. So what I'm currently monitoring is this: if we overthrow it, obviously this was not a terminal formation. But on the other hand, if we actually break below it, that's bad news for the USD yen, because at the very minimum I would expect a move back to 111.70. Something that works well for the bearish scenario here is the Nikkei, and somebody's going to say, what the hell do you mean? I mean, this thing is insane. This thing is parabolic. It breaks, you know, one bullish channel just to be in a steeper bullish channel, and it's about to break above that as well. I mean, today, once again, we had a 1.5% move higher. The problem, though, is the following: is that currently USD yen is more or less testing the highs that we had back in the middle of July. And the Nikkei, after one of the most insane moves I remember seeing in the past few years, is more than 10% higher in the equivalent level it had back in the middle of July. What I'm trying to say is that after mounting a move that is definitely unsustainable, it can be only sustained for a few more days. I mean, we're already, come on, don't play hard. We're already 19+% higher within 42 trading days. The USD yen has not managed to break that high, right? So obviously we're going to be seeing some kind of a correction rather soon. And the question is, what is the USD yen going to be doing then, right? So I would be very careful with the USD yen there. And obviously buying Nikkei up here is, you know, I don't know. I don't know. It's more than nuts, probably. We're almost 20% higher in 42 trading days. That's less than 2 months, actually. So that would imply, like, because it's not even 2 months, so that would imply more than 125, 130% yearly rate of increase. I mean, no, that's not going to happen. So be careful here with the USD yen. This is what I'm monitoring. I was watching for 116, but I'm not even sure we're going to make it to that area. Okay, especially if we see some kind of risk aversion, because in general, if you see at all the stock markets, just look at the SPX. This also displays some sort of ascending wedge here. We have been barely holding an ascending channel for several days now. We actually broke below it a couple of times intraday, but we did end up holding it. The VIX has remained extremely subdued for several days. We had 2 days ago on Friday, we had a record closing low, an all-time record closing low. I mean, at some point, some kind of a risk aversion factor is going to come through the markets, and USD yen is not going to react well to that. It's underperforming anyhow several classes of assets, etc., that is usually strongly correlated with. So the question is, what happens then? Obviously, it's going to move lower, or not obviously, but most probably it's going to move lower. Okay, so let's have a look at a few more pairs, and then we can take a few questions, and Blake should be with us in 10 minutes from now. Let me open the question box and see what we have. Euro yen. Sure, we had a look at the Euro USD, so let's have a look at the Euro yen. I think the Euro yen is one of the most obvious pairs out here, simply because we have a potential double top, but for that to be triggered, we need to break below this extremely well-defined horizontal support area, which also defines this range. So in essence, we have been in a range since the middle of September. We are now approaching the middle of November, so it's almost 2 months. And a daily close below this 131.60 level is going to confirm a break of this range, and the next move you should expect, if that happens, is to at least come down to test this horizontal support area, which is exactly 200 pips lower. Okay, it can move lower from that as well, but I mean, at the very minimum, in that case, I would expect this area to be tested 200 pips lower. So things are very, very clear here. Do you believe that the euro is going to move higher from here, or the yen is going to accelerate higher, or even better combination of the two? You have a very clearly defined reward to risk ratio to be long at current levels, and because you have a very clearly defined stop loss, which would be, let's call it roughly 40 pips lower from here. And then you would at least target this, this area, the double top area at 134.30. On the other hand, if you believe that the Euro USD has more to move lower and the USD yen is in danger of rolling over, then you are most probably expecting a break below this zone, and then you know where you are going to be triggered to be short, and what your target is going to be. Now, about your stop loss, logic says that it should be above this, you know, little peak here. Also, if you see, and you know, it's more clearly seen if we go to a 4-hour chart, but it's not really needed, so I'm not going to switch. This looks like a head and shoulders as well, right? It does. So, you know, this is everything you need to know about the euro-yen. Cable, sure. I know a lot of people are wondering what the hell is happening with the cable. What is happening with the cable is the following. The cable is currently stuck more or less in a range. I think this range is a triangle, actually. There it is. We had discussed that probability with Grega. What was it, Thursday or Friday that Grega was with us, Dale? Anyhow, doesn't really matter. So as long as we remain above this area, roughly the 130 area, you know, you can't be outright very much bearish, although you might have your bias that this is one move lower, this is a consolidation, and we have at least one more move lower. That's my bias, by the way, that there is a good chance that we're going to see another move lower. On the other hand, we're currently in the middle of this little triangle, so, you know, unless you're already committed to it, I think I would be, you know, more patient. Now, on the other hand, you know where resistance is. Resistance is the confluence of this descending trend line resistance of the triangle and this horizontal area. So I would say anywhere between 132.50, 132.80, you know, you have resistance. So you know where support and resistance is. And until then, probably it's the best idea, you know, just monitoring and not doing much with it. Lucas says, new government using a lighter hand than expected with RBNZ. Favor Kiwi bounce to retest 730 breakdown point. First of all, great commentary having to do with the political stuff. Yes, the expectations were that they would be a lot firmer with RBNZ. And you're looking at this area, you said 70-30. Do you perhaps mean 70-60, the 70-30? What can you mean of this channel? The breakdown of the channel, of the descending channel, Luca? Because that's somewhere there. Yeah, so I'm guessing this is what you mean. Yeah, we might get up to there. For me, though, I reiterate once again, 69.70, quite an important zone. So I would be looking at that. After that, I would be more inclined to be looking at this area, the 70.50. If you see, we also had highs here, there as well. It was this low here. So probably if we break above that, my intuition tells me that I would be looking for 70.50. But even if that happens, I would still not turn bullish the Kiwi. So I need to make, you know, to be clear on that. To Yellen, the private sector is a myth. She's never seen it. I agree with you, Andrew. And not only to Yellen, to many of those. Why is the Swissy strong today? Which pairs do you mean to begin with? Because, let me see. If you mean why is the USD Swiss strong, first of all, it's not that strong. Second of all, don't forget that it's inversely correlated to the Euro USD, right? So no big surprise there. Now, having to do with the Euro Swiss, it's not that it has been a strong mover. It's in a small correction lower. But you know, other than that, I wouldn't give much weight to this kind of move. I mean, you know, it has been extremely strong. Nothing moves in a straight line. Euro Kiwi, head and shoulders in play. May have another.
On Euro Swiss last week, Steve, I did bring people to attention to it possibly being the top of B and C could be underway.
Oh yeah, sure.
Yeah.
But I remain constructive in the. I'm guessing this is what you call head and shoulders, Luca. Here, if we see it on the 4-hour chart, yeah, it might move lower, but I have to tell you that it's currently testing the first area of support I had marked on the chart. So, you know, the first area I was looking for possible support is this, and then if you want a second area of support, is probably this. I mean, I would check at this trend line because it also confluences somewhere there, somewhere here with the 50 DMA. So I think 165.80 is also an area of support. I need to reiterate here that I'm not bearish the Euro Kiwi. I'm not bullish after we retested and got rejected with a tweezer top from the channel because that was a perfect rejection. But I would rather look to buy the pair lower than being short. Okay. So we still don't see a stronger reaction. So yes, we can definitely move lower from here. The 165.70 area is 140 pips lower than where we currently are. So yeah, sure. I mean, yeah, it can definitely have more downside. We still have no indication that you know, the uptrend is resuming. That's the only certain thing. Amit says, sir, ascending triangle is a bullish trend when the stock is making higher high, higher bottom. Depends on the triangle. If it is a triangle, yes. If it's an ascending wedge, because an ascending wedge, geometrically speaking, is also a triangle, but it's a very, very specific triangle that usually indicates exhaustion. Okay, Amit? If one of you helps me doing technical analysis for one trade, I would like to send the chart in his email. Thanks in advance. Yes, sure, you can send. I'm going to send you my email. You can send me a chart if you want. Okay, this is my ForexAnalytix email. You can send it to me. Euro yen, we saw it. Nikkei, would you buy on a 5% dip? Depends, Martin. I want to see how this dip is going to, you know, happen. I can tell you if it's going to be a 5% or whatever. If you're asking me if I would buy Nikkei on generally on a dip to, you know, to see it go higher, probably I would, but I'm not going to do so. Most likely. Hawks, Fisher, and Dudley out. Dove Powell, new chair, already talks of price level targeting by the few Fed members. Let inflation run for a while above target. Think we have the makings of a new leg down in the dollar after December hike. It's very likely, Luca. There is absolutely no question that the Fed we're going to have in hands in a few months from now, on average, is going to be more dovish than the one we currently have. Now, having to do that about them changing their targeting, etc., I think it's also going to be dependent on other factors, like how stocks are doing, how the economy is doing, how oil is doing, because don't forget that oil is going to have temporary spillovers to the inflation. So if oil spills over to the inflation, that means that they're going to have less of you know, an excuse to you know, to use inflation as a reason for them to be more loose, having to do with the monetary policy. It also depends on something that they will never admit, which is what? How they think, I mean, what they think about valuations of assets at the moment. Because trust me, if, for example, they think that many assets are on a bubble or about to be forming a bubble at the moment, that's something, first of all, that they will never admit, but that's something that they will definitely take into account in their policy. Okay. Ronit says,
good morning.
Hey Blake, welcome.
Thank you. How you doing?
I'm good.
I know you're answering questions, and I'm one of the reasons why I wanted to do the second half is also so I can address some questions.
Oh, okay.
I'm not able to address questions. I'm just going through some charts really quick and
okay, mate. I didn't know that.
But,
I thought
no. It's completely fine. Continue. Because there's not. It's like such a slow session at the moment.
Yeah, and yesterday's session was rather slow as well, I would say. Very slow, actually.
It was extremely slow. When I looked at the amount of updates that I did on ForexAnalytix, which was very few, and that, you know, that tells me that that tells me how slow or how busy of a day is when I'm doing multiple updates throughout the course of the day, or like in the case of yesterday, it was extremely slow and there's very few updates. Just because, you know, the dollar was moving, but it was counter trend and it was very slow counter trend. So anyway, but you were talking a little bit earlier about the dollar. You know, there's something that that is the one asset right now that makes me question the dollar's weakness at the moment, and that's the bond market. Because if you look at the 10-year, the 10-year is actually still quite strong, and we're holding on to gains from the last you know, week. And when you look at the 10-year and you look at how, you know, how it strengthened the last week, it's either, you know, it's either about ready to roll over, but as you can see, like even on an intraday basis, it's bid right now.
For example, look at the bonds. What I'm saying here is that you're absolutely right. The bonds in general are moving higher, but you know, having to do what we care about seeing dollar's performance is the relative performance of the bonds to other bonds. So, for example, yes, I expected, for example, after the break below this channel for the treasuries to resume lower. But on the other hand, the bonds have outperformed them, and that's why we are seeing Euro USD continuing this slow move lower. And on the other hand, you know, this move higher so far does not look impulsive to me. I mean, look at this. We've spent the past 1, 2, 3, 4, 5, 6 days slowly creeping higher. Usually that's not, you know, a sign of something that wants to explode higher.
Couldn't you say the same thing about the dollar?
Yes, absolutely. Absolutely.
Okay, so,
and I do believe that the dollar's move higher is corrective. I 100% believe, and let me reiterate that, because I've said it in the past, but I haven't repeated it the last few days to people on the webinar. I do believe that the move higher from the dollar is corrective. My only problem with calling a reversal to this correction is that time-wise and price-wise, I would rather see it extend a little bit more and a little bit longer. That's the only thing I have to say.
Well, let's please not make this go longer, because it's been a
yeah, I know exactly what you mean.
slow, brutal move.
Yeah.
Yeah. So, but you know, I get what you're saying. So, but at this point, you pointed out like the yen, and the yen is like, you know, it's obviously something that we should pay, you know, obviously very close attention to. And you talked about, you know, how it moved yesterday and the night before. Now, did you notice that the Nikkei is, you know, has exploded again overnight?
It's the first thing I talked about in combination with the USD yen. I said that, listen, the Nikkei continues exploding higher. The Nikkei is currently more than 10% higher than where USD yen was at this high, which we failed to penetrate above. And at some point, this parabolic move of the Nikkei is going to be reversing and for at least giving us a correction. And what's going to happen with the USD yen then? That's exactly what I said.
Right. So, I mean, that to me is like very, very, you know, concerning, especially if you're long the dollar yen. I mean, and from all accounts that I've seen, you know, the market is extremely bullish the dollar yen. On like I said, on all the accounts that I've seen, which doesn't mean it's going to continue, but I'm just saying, or it doesn't mean that it can reverse, but everybody is bullish the dollar yen. Everybody's expecting a breakout. We had Adam Button from Forex Live, and you know, he was talking about, you know, the dollar yen should be higher, and what if it does break out? And will that and I can't say it's off the table, the potential of the dollar yen breaking out, but if you're long the dollar yen, how frustrated are you at this point when you're sitting here watching? What was the Nikkei move? What was the percentage move? on the
Now
Nikkei?
we've reached more than 19% higher in 42 trading days.
So 42 trading days, you've got the Nikkei that's 19% higher, yet the dollar yen, which is one of the more stronger correlated currencies, has not. Now a lot of people say, well, that maybe it's because the yen is being used to fund Nikkei purchases, whether it's by the BOJ or the Japanese Post or whatever the case may be. But that correlation is broken down to a point where if you're long the dollar yen or any of the yen pairs, shorting yen, you're probably a little frustrated because you looked at the euro yen, you looked at the you could look at the pound yen, you could look at a lot of these yen pairs, and they're just not following suit. And I think that frustration's got to build to a point where I think you rightly pointed out is if the Nikkei does reverse,
it will at some point. This is unsustainable. For more than a few more days. I mean, how much is going to move higher? 30% in a straight move. I mean, I've never seen that happen. You know what I mean?
Yeah, I mean, it's not common. That's for sure. It's and so I think, and I'm long yen, meaning I'm short, dollar yen right now. I've got some short euro yen. I've got some short pound yen on the board, and because I think it is a problem if we do see, what I'm hoping for today is I'm hoping for the Nikkei to post a false breakout above this big fib level, because we're at 127% extension, and we broke above that in the Nikkei today. So if you take the
I know, here it is.
Yes, so we're making this big move above the 127% extension, and I'd love, and I'm hoping, not expecting necessarily, but boy, would it be great, is if we see a big, massive false breakout, and we close with a reversal candle. That would be that to me would probably signal that I need to press yen longs, meaning I need to short more of the yen pairs. And if you look at the S&P and the NASDAQ, they're kind of languishing at the moment. That doesn't mean anything because as soon as the stock market opens, the big flood of money comes in usually to buy. So, but it would be a pretty good indication for me if we got some reversal and risk appetite today to establish even more of a position in the yen, being long more yen. That would be my cue, really.
Definitely, and don't forget that from a monetary policy perspective as well, something else that should worry the people that are currently long USD yen is that, I mean, more powerful statements than the one Kuroda made on Sunday. You can't get more powerful than that, and still the market completely ignored it, right?
I agree. I told the guys that I trade with, I'm like, look, if these comments don't break out the dollar yen, I don't know what's going to break out the dollar yen.
Indeed.
Yeah, and that was my attitude basically on Sunday night, Monday morning. So just some some food for thought there. So anyway, Steve, are there any other questions that you want to
No, I'm giving you the screen. There are some few questions that are coming in. I'm sure you can address them. There
okay.
You go, Baker.
Great. All right. Let's see. I'll take over from here. And this is the Nikkei, for everybody that doesn't or hasn't seen it. And Steve pointed out here. I mean, you see this move. I mean, it's crazy, man. 19% move.
Not only that, the Nikkei is currently climbing with a geometrical angle of 62 degrees. I've only seen that kind of stuff in 1999 stock market and cryptocurrencies.
It's nuts. Now, if you look at it from a longer term perspective, I mean, we're still, we're challenging levels from 1996, but we're still well below the historical highs in the Nikkei. For those of you guys that remember the moves back in the late 80s, which I wasn't around trading the markets at that point. But I mean, that was the parabolic move, and it all went to, you know, obviously to hell in a handbasket in the Nikkei, and we've had a hard time recovering since then. But it's something worth noting that we're challenging some pretty big, you know, resistance on the way. You know, and I was actually reading another analyst talked about inflationary pressures that everybody feels like big time inflation is coming down the pike. And this analyst was pointing out a bunch of different things, and he said, you know, inflation, you know, and the, you know, expected, you know, rampant inflation here in the U.S. He goes, see Japan. And what he was basically pointing out is, you know, Japan has been is really been the epicenter of a deflationary environment for the last, you know, 30.
Poster child, bro. Poster child.
If you think about it, if you think about, you know, where we're at right now in our you know, cycle, you know, in equities, would it be very similar to something that looks like this, you know, in the U.S. stock market? No, I'm not suggesting that the stock market is going to see, you know, we're going to see this type of move, but would it be possible, you know, would it be possible that the U.S. stock markets, you know, make a U-turn at some point? And, you know, I mean, it would be not pretty if we went from, you know, like okay, you want to talk percentages, you know, the Nikkei lost 80% of its value over the course of, you know, however, whatever length of time that is, you know. So, you know, you're talking 80% of its value over the course of, I don't know, 20 years. I mean, that's crazy. I mean, you if you think about that, and I don't think the U.S. is going to be dealing with anything like that. But at the same time, you know, if it's happened to Japan, is it a possibility of happening to us? Sure, but more importantly, I'm scared that the U.S. is falling into a very similar trap that Japan did. You know, as everybody's expecting this higher rate of inflation, but are we gonna? Is it really coming? I mean, we have Fed governors that talk consistently about you know, inflation. Not just our Fed governor. I'm talking central bankers all around the globe talking about inflation forecasts that are really quite benign. Wouldn't you agree? I don't know if Steve's still listening in.
Oh,
Steve,
yeah,
Steve,
I totally agree,
yeah.
But it's a matter of demographics as well. Don't forget that, for example, the reason Japan was the first country to be hit by deflation is the fact that, for those that don't know it, Japan is one of the most closed nations.
Right. Yes.
Exactly. They don't accept immigration. They don't have open doors. They don't like to blend in.
They have a huge demographic problem with aging population and everything else. I know it's huge.
Proven from economics papers, etc., that the more a population ages, the lower the inflation is for obvious reasons, which means that you can't beat the demographic aging of a nation no matter what you do. I mean, under normal circumstances and monetary policy. So you either embrace it or you do something about your demographics.
Right, and which they chose not to do. That's why I don't think that we're in a similar situation to this. You know, but are we in a situation where the market comes to the realization that, you know, maybe inflation isn't such a big issue? You know what I mean? And we see, you know, the stock market come off rather aggressively at some point. You know, and that's what I think worries me about these parabolic moves that you see not only in the U.S. stock market, but in a lot of different markets. That the parabolic nature, and I'll tell you from experience from just 20 23 years of moves that I've seen, parabolic moves don't last, and when they reverse, it's very damaging for the markets. You know, you could see it from, like, if you take you know, crude oil, for example, and you look at the parabolic nature of crude oil. You know, back in this is 2006, I believe, 2007, and the, whoops, here we go. I'm sorry, it was 2008, and you see the big reversal there. I mean, this is a good example. U.S. dollar Canadian, you know, a great example of parabolic moves that don't last. This was a capitulation low, but you know, capitulation or, you know, blow off tops are very similar. They're just opposite on the sides of the chart. The U.S. dollar Canadian gave us a very similar look, where you know, everybody wondered, you know, oh my God, the dollar is going to fall out of bed. And then, you know, at that point in time, I said that was a generational low. I don't think I'll ever see that price again while I trade, and that has been, you know, the case ever since then. But you know, that's the thing that scares me the most about what we're seeing in this runaway market, is that when or if, and I'm assuming, you know, it's going to end at some point. When or if we see some sort of you know, blow off top, it's going to be very damaging from a technical perspective and sentiment perspective too. You know, you're going to be in a situation where people just don't want to buy. Then you get the you know, the buyers a buyer's strike, and people just don't want to be long equities anyway, because they're going to look at it overvalued or whatever the case may be. And I'll tell you something. It was an interesting conversation that I had with, I can't remember who it was in our chat room the other day. Said, well, you know, I don't have any reason to sell stocks. There's no reason to sell stocks. And I'm like, you know, I can give you 1,000 reasons to sell stocks right now, but none of those arguments are relevant to the market at this point. When the market's attitude changes and the market starts, you know, we start seeing a reversal, whenever that is, whether it's today or, you know, 6 months from now, or, you know, whatever, whenever the market grasps those ideas, it's not going to let go. And when sentiment changes, it's hard to change it back. So right now, you know, everybody's like, well, why should I sell stocks? You know, there's no reason for me to sell stocks. And I get that. But I get the reason the market comes up with that. But at the same time, if the market sentiment changes, it's going to be really hard to change it back, especially at such lofty levels. Now, I want to address a couple questions, but I'm going to reiterate a few things that Steve talked about earlier regarding, like, the euro. So the euro, you'll notice that the euro is coming down, or the dollar is strengthening. Is very technical, as he pointed out. It's probably one of the best, has been one of the best and most well-mannered technical charts that we've seen in a while, because we have this head and shoulder pattern, which has been almost symmetrical. I mean, perfectly symmetrical. We had a really big reversal last Friday at non-farm payroll, right at the neckline, which was perfect. But if we're going to talk, technicals and how perfect the euro dollar has been acting technically, then we must talk about us approaching 161% extension, and the RSI, you know, like this on a 4-hour, but you can probably see it on a daily too. Well, the daily is just, you know, it's not oversold yet, but on the 4-hour, it's very divergent. So, you know, to me, that suggests that we might have a situation where the euro dollar could bounce, since it is respecting technicals pretty darn good at the moment. So I'd be a little careful about being short the euro dollar as we approach this 115.38. You know, are we eventually going to complete this head and shoulder pattern? This eventuality, it could happen, but also keep in mind that this head and shoulder pattern, if we, you know, do complete it, I mean, it could complete it 2-3 months from now. So just because we are going lower in the euro dollar doesn't mean that we're gonna, you know, go straight down. We might, you know, hit this, you know, 161% extension, bounce, then head, you know, break into a new low, then bounce, and, you know, eventually, you know, drift our way down towards the, you know, 112, 113 area. But that's the, you know, again, it's just a little bit of a warning down here, is that we're starting to get comments from the ECB. We saw them this morning about backpedaling a little bit on quantitative easing, which could get a little bit of a lift in the euro dollar moving forward. And I want to go reiterate what I was talking about the yen, and I know Steve had already mentioned it. We're up against really critical symmetrical triangle resistance in the dollar yen. Not only is it a major resistance from a horizontal standpoint, but also this horizontal resistance, or triangle resistance comes into play right where we're currently at, and you could arguably say that we tagged it on Sunday night. Now, you can see I set an alarm here. I set an alarm from 113.50 because personally, I don't want to get excited about any downside in the dollar yen until we start printing lower lows. Once we start printing lower lows, then I'll get more excited about it, because I am short some dollar yen currently. I want to add, but I don't really want to do so unless the market starts showing me its true colors. But again, I want to go to bonds. If you look at the bond market has gotten a pretty decent bid off of these lows, and bonds aren't coming down. I mean, if the bond market was coming down and yields were going higher, that would be one thing. I'd be saying, okay, well, we got to look at this dollar, and it's going to continue to strengthen here. But if the bond market continues to rally, that means yields are coming down. If yields are coming down, then that is going to be a problem for the dollar yen. Typically, the dollar yen is going to be most correlated to yields. So if prices are coming down, yields, if prices are going up, yields are coming down as well. Now, I wanted to talk about a few of these yen pairs, because Steve had mentioned, yeah, we got a head and shoulder pattern here in the euro yen, and this is where the very, very, very important support comes in the euro yen, and it comes in at 131.50, and we're trading not too far away from there. We're at 132 basically. A break below this low, and a solid break, like not like we tested it the other day, but a close below here, and really if we start trading below this in a more significant manner, then you have a double top, which points to we got to move down to maybe 129. So I think the euro yen has got a great setup for a double top. It hasn't it hasn't played out yet, but it's a great setup. But there's other yen pairs out there too. I mean, here's the pound yen. A pound yen, we've got a really key trendline support that's about around this 149 level. A break below 149 would be pretty bearish for the pound yen. The Aussie yen, even following the RBA decision last night, I mean, it's a little weaker as well. New Zealand yen, we keep challenging the underside of this trend line, which is interesting because it's really capping us here. The New Zealand yen could roll over and start showing some signs of bearishness, and the Canadian yen, which we had this big failed inverted head and shoulder pattern. I mean, this Canadian yen's got a nice reversal candle setting up right now, which I think has probably caught a lot of longs off guard. So these yen pairs are already starting to show some weakness, which is interesting when you have equity markets that continue to move higher. And let me be more specific here. Let me take the S&P, and we're gonna do this, okay? And I'm going to compare the dollar yen, pound yen, euro yen, Aussie yen, New Zealand yen. Okay. So you can see all these yen pairs and how they've really diverged away from equity market strength, if you will. And I think this is a pretty good representation of where those correlations, I would say they really all started to break down about the midpoint this year. Everything was, I mean, they've been slowly diverging, but those correlations have really broken down I would say around this time, maybe February or March of this year, as the stock market continued to go higher, and these pairs have been really just more or less sideways. So that to me is something that, you know, we all have to pay very close attention to, because the stock market is going to find a peak at some point, whether, like I said, whether it's today or, you know, 2 weeks from now or 6 months from now. Whenever it does, these yen pairs have to be on your radar for possible reversals. So anyway, just thought I'd leave you guys with that. Dale, how's it going over there? Yeah, I think Dale went. I think Dale went for a run or something. I think he took off. He might have.
No, I've been listening. I've been listening to your. I've been listening to your analysis. Yeah, right, Peter's here. Peter's here.
Oh, Peter's here. Great, great. Okay, let me see if I can address some of these questions. Oh, Peter is here. Oh, it's that time. Shoot, I didn't realize I ran out of time. Well, Dale,
okay. I'm gonna used to do it all the time. So well, yeah, I'm used to it.
I'm going to pass it over to you, and so we can all welcome Peter. And thanks for the opportunity to listen to him. And we always get an opportunity to hear him on CNBC. It's nice and it's nice to hear an extended interview with Mr. Bachvar. So thank you very much.
Okay, Blake and Peter, I see you in the house, and I'm going to make you a panelist, because I'm showing your blog and your website. Can you hear me, Peter? I think he disappeared. Peter, are you there? He was here for about half an hour. Yeah. He seems to not be around anymore. So we'll see if he checks back in. If not, we'll call it a day.
It seems like he's back on, Dale.
Can you hear me?
Dale, he's here.
Hi, Peter.
Hello.
Hi, Peter. How are you?
Good. How you doing?
Good. How are you, Pete?
Good. Thanks for having me.
Thanks for coming back. So great time to have you with all these parabolic moves happening in different bourses across the globe. And why don't we start with the most extended? And I'm interested in what your thoughts are on the Nikkei being the most parabolic, almost looks like Bitcoin to me. And your thoughts of the BOJ being a participant in buying shares. So why don't we start with the Nikkei, and what's your take?
Yeah, I mean that's certainly that's been the case for the last couple of years. But I look at the Nikkei more as just playing catch up to the rest of the world. I mean, up until 2 months ago, the Nikkei was essentially flat on the year. So
right.
So and the thing with Japan is, corporate Japan, we're seeing high returns on equity, improved governance, stock buybacks, dividends. They're beginning to do what most other countries and companies have done, for years now. So I look at Japan as just really playing catch up, but obviously certainly juiced by what the Bank of Japan has done. There's no question about that. But again, up until 2 months ago, I think the Nikkei was basically flat on the year.
Okay, so that's a good point, and Blake showed a long-term chart from the highs in '89, and we're probably at halfway back, 61.8 back after losing 80% of its value from that peak. So maybe it's a last hurrah, and it's really this whole thing that looks spectacular on a longer-term basis could still be called the bear market rally. You think I know you're more positive emerging markets, and definitely Japan is not emerging, is it?
Yeah, well, I think Japan is, Japanese stocks are going to be a beneficiary of problems that the Bank of Japan is going to face. I mean, if you're living in Japan and you have savings, well, do you want that savings to be in yen? Do you want that savings to be in a 10-year JGB yielding 4 basis points? You may maybe out of pure defense may want that to be in Japanese stocks.
So it's Tina over there as well. There's
always an alternative, but I just think from a preservation of capital standpoint on a real basis, people may just choose to own Japanese stocks just to protect themselves.
Okay. So why don't we move a little further north from Japan? And I'm looking at your blog right here, Peter, and you gave a thumbs up to the PBOC's governor talking about leverage and that he's being realistic, which is unusual from what you hear from a lot of central bankers. What's the gist of this article if I clicked read more?
Well, if you listen to Mario Draghi and Kuroda and Janet Yellen and Bernanke before, there's no such thing as an unintended consequence of what they've done. Everything has a purpose in their eyes, and everything they do is for the better. And we obviously know that's not the case. And to hear the head of the People's Bank of China basically come out and say, there are major unintended consequences. We do have a major and dangerous buildup of debt and malinvestment and inefficiencies, and it's refreshing to hear a central banker talk about that. Now, what can be done about that?
Can you walk the talk? Easier to talk the talk, right?
Right, exactly. And in China, it's not as easy to walk that talk, of course. But it was refreshing to hear a central banker. And it reminded me of what we heard from the ex-Reserve Bank of India central banker, who seemed to be ahead of the curve in acknowledging the major buildup in risks that we saw in 2006, 2007, when he spoke in front of other U.S. officials and said that we have a major bubble on our hands, and you better watch out. And Larry Summers laughed at him. So again, what comes of that out of China doesn't necessarily mean anything, but acknowledging that you have a problem is the first step to dealing with it.
Exactly. So China no longer in denial. How about Powell? What are your outlooks for the new Fed chair here? Same as it ever
Powell
was.
Powell is just a repeat of Yellen. He voted for all the QEs. He voted for 0 interest rates. He voted to keep them there for 7 years. In a way, he's almost just a figurehead. I mean, I think that no matter who's in that seat has an extraordinary job ahead of them in that shrinking the balance sheet and continuing to raise interest rates is only going to end in one way, and that's a recession and a bear market. I don't care who's in that seat. So he's just a replay of Yellen.
Are you saying you wouldn't want the job, Peter, if it was offered to you?
Oh, I would take the job, but I would be honest. I would say, listen, guys, it's time for a recession and a bear market because it's going to happen inevitably, and it's better to get it over with sooner rather than later. It's better to do it now with asset prices at this level rather than blowing that bump even further into the future.
And wouldn't it be better politically for the president to get it out of the way, so perhaps at least the worst is behind us and we're coming out of it, going into his re-election cycle?
Sort of a Volcker type mentality, but no president politically wants to preside over that, and certainly Donald Trump, who talks about the stock market every day, doesn't want to see a bear market when he keeps tweeting every couple of days about the record highs that we're seeing. So it was almost obvious that it was going to be Yellen or Powell. I mean, this dance around Warsh and Taylor, that was just an optics game, because there's no way that they would cede power to a central banker that doesn't believe in near zero interest rates and doesn't believe in QE.
So if Powell is the figurehead, where's the power on the Fed? And do you see anyone that could sway the Board of Governors to finally, address these emergency levels and begin to withdraw the balance sheet and take the risk that asset prices may fall? Is there any voice on the Fed that could hold sway over Powell?
No, and interestingly, there's no voice. I think that the Fed and Yellen have decided to turn quantitative tightening into sort of this self-fulfilling prophecy by just letting it happen itself.
Okay.
is what will have the power, because that will eventually, well, it needs to happen. The Fed needs to get out of the game of manipulating asset prices. I know I'm stating the obvious here, but particularly in the mortgage-backed security market. I mean, here you have on a median basis, record high home prices and rents that are going up 4 to 5% a year, and the Fed is sitting there buying mortgage-backed securities. So it needs to happen. But anybody who thinks that this reversal of Fed policy is going to lead to a soft landing, I think is delusional. This is going to end in an accident. It's just a matter of when that happens. So when you talk about the power, it's almost that the market now has taken over. As long as the Fed is willing to just let the balance sheet go, things will just happen until something breaks. The Fed will keep raising interest rates until something breaks, which is typically the pattern. And this pattern is not going to be any different.
It'll be crisis management instead of preemptive action.
Yeah, of course. And then a lot of that is because, the Fed delusionally believes in what they've done, and they don't see the unintended consequences of what they've done. But it'll be the market that will tell them, look at what you've done, and as they've done twice in the past 20 years.
Okay. In our last interview, you thought the fuse for this thing to be lit would come out of Europe from Draghi. Obviously, the last ECB meeting, it doesn't look to me like he lit the fuse, and we were having a pullback occurring in Euro. Do you think that Draghi eventually is going to be the catalyst still? Or,
yeah, I do. I think,
okay.
I mean, the European bond market is the epicenter of the epic bubble, and I think with some interesting things that have happened at least the last couple of days, and even today I wrote a note that said higher inflation in Eurozone is very underappreciated risk. So we know Draghi is cutting QE by half beginning in January. Well, anecdotally, I'm seeing inflationary pressures building up in Europe, and yesterday, the Eurozone Services and Manufacturing PMI from Market. This is what Market said. Inflationary pressures have meanwhile lifted higher, with price charges for goods and services rising at a rate not beaten for over 6 years. Some price rises merely reflect the pass-through of higher costs, but companies are also reporting stronger pricing power as demand conditions continue to improve, which suggests underlying inflationary pressures are becoming more ingrained. That was yesterday. So today, Market has the statistic on German construction, and they write intense supply chain constraints contribute to sharp rise in input costs. The incidence of delivery delays was one of the greatest seen for over a decade, while purchase price inflation was pushed to a 6.5-year high. They also came out with their retail PMI today, in that it said gross margins facing Eurozone retailers continued to be squeezed at the start of the fourth quarter. Contributing to falling margins was another rise in average input prices. Moreover, the rate of inflation quickened to a 57-month high and remains substantially greater than the long-run series average. Yesterday, the CRB index, I don't know if people noticed, but the CRB index had its second biggest day in a year. The CRB index closed yesterday at the highest level since February.
Yeah.
So there's inflationary pressures that are building. Now, if you look at the German 10-year yielding 34 basis points, if you look at the reported CPI number, and if you look at the high-yield debt in Europe yielding 2%, you wouldn't think that. But if you just dig a little deeper and you see these anecdotal bits of information and you see commodity prices moving up, an unappreciated risk that no one is talking about is a quicker pace of increase in inflation in Europe, which would completely throw out Draghi off kilter, even with him cutting QE by 50%. So I see major issues with the European bond market next year that will filter over to bond markets around the world in the context of asset prices that we know are highly inflated, but have been for a while.
Could oil be part of the story, Peter? I mean, people have been bearish oil for a long time. We had that collapse a year and a half ago, and you know, the charts are looking okay in oil, and there's some geo stuff happening in the Middle East right now
Yeah,
with Saudi Arabia.
that will be part of it, no question about it. But you also have labor markets that are tightening around the world, even in Japan. Okay, so today,
Wow.
or September, Japan reported base pay, so regular pay, not including overtime, not including bonuses, rose 0.7 year-over-year. Now, it doesn't sound like much, but a 0.7 gain in regular pay matches the fastest increase in wages since March 2000. So
Wow, that's
maybe even Japan.
Yeah, even a demographic that's pretty negative, they're seeing wage pressure.
Yeah, and I bet you if you pulled a room of 100 people and saying, do you see inflation as a threat over the next 12 months, you know, 90 of them would probably not raise their hand. So I think that is something that we should be paying attention to, because that would really throw everything off base. And you talk about who's the power in the Fed. Well, if this inflation talk starts to percolate, particularly overseas, well, then the market will be the power that takes away some of the ammunition from central banks.
So the bond vigilantes will make a reappearance. You know, I've noticed the bonds, you know, really, you could say that they topped 2 years ago. They're not making a lot of downside progress or upper moves in yields.
Yeah, no, not yet at all.
Yeah. So do you think we'll get through 265? That was kind of like PIMCO's, or the old PIMCO, Bill Gross saying over 265 in the 10-year is kind of going to be the catalyst for sharply higher rates and a repricing of asset classes based on rates and PE?
I think if the German 10-year Bund yield gets to 1% again, then there's a very high likelihood. And we have to remember, in 2015, in the summer, the German 10-year got as low as 6 basis points intraday. 1 month later, it was 60 basis points. A month later after that, it was 100 basis points. So risk happens fast. And if what I mentioned in European inflation starts to show up in the statistics, risk can happen very fast in yields there, considering the extent of that bubble. Now, on the other hand, we have the Fed that's raising short-term interest rates, and we're seeing, you know, 10-year highs in 2-year note yields. And that is going to be an inherent flattener of the U.S. yield curve, because it's paid to flatten the yield curve in the previous rate hike cycles, because we know they typically end in a recession. So it is going to be a tug of war in U.S. long end yields between getting dragged higher by potentially higher interest rates overseas, but then the threat of Fed hikes in the short end, flattening the curve, you know, pulling it down again, because people are worried about the growth implications of monetary tightening here.
Yeah, people are poo-pooing the flattening of the yield curve, saying that's more of technical reasons. Do you think there's a shot if the Fed tightens in December and then keeps moving next year of it inverting? Or will they step in and
very much a high possibility, because this typically ends in recession. The last 13 rate hike cycles tend to put us into a recession, and considering how dramatic this accommodation has been, why wouldn't this one put us into recession too, especially in the 9th year of an expansion, when most expansions last, you know, 7 years, 6 or 7 years. So that's likely to happen. Now, we don't need a reversion here, though, because the yield curve is still so distorted by monetary policy that you don't need a reversion to tell you that something's amiss. You know, in December, a month after the election, when everyone was excited about Trumponomics, the 2-10 spread was 135 basis points. Today, it's barely above 70. Now, it's not close to an inversion, but if you don't take a message from that, then I don't know what you're looking at.
Okay, Peter, last time we were on, you have a long-term bearish view in the dollar, and you were right. I mean, the euro had one heck of a move from the last time we spoke, peaking a little bit above 120. I'm assuming that you're looking at this pullback in euro as being potentially a great buying opportunity. Where is your head at on the euro and the dollar? This is a bear market rally in the dollar, because some way people think there could be a blow off in the dollar to new highs.
I think just as in the beginning of the year, the dollar bull case was hugely crowded, a month ago, the dollar bear case got extremely crowded, and
Okay.
Draghi reminded everybody a couple of weeks ago how slow he's going to be going in reversing policy. So that was enough to see this knee-jerk dollar bounce. But I'm not a fan of the dollar. I acknowledge this counter trend rally. It could last. Maybe the euro continues to sell off here, but I'm a bear on the dollar across a variety of currencies. But again, acknowledging that it could further bounce here, no question, as the Fed tightens again in December, and we don't get another rate hike from the Bank of England, and maybe the Bank in Canada is done for now. But because of the economic worries that I have with the U.S. economy in this tightening, that will eventually be dollar bearish again. I mean, people understand that we don't have economic cycles anymore. We have credit cycles. And here you have the Fed tightening monetary policy in a credit cycle-driven economy. It seems to me obvious where this ends up, but I still think there's this belief that Trumponomics and tax reform and can somehow bypass the tightening of monetary policy. That worked in 2017 because we also had massive money printing out of the Bank of Japan and the ECB. But I think, unfortunately, 2018, it'll be monetary policy that eventually wins out in terms of its impact on economic activity and the cost of capital.
What an enlightening conversation, Peter. I have your website up here. Is there any feed for people to subscribe to your book report?
Yeah, they can go to bookreport.com, BOOCK report.com, and they can sign up for a free trial. Okay. They can sign up per month. They can sign up per year.
There you are.
Yeah.
Okay. I encourage people to check it out because you're one of the few people that when I have CNBC on, Peter, I turn up the volume.
Thank you very much. I appreciate that.
And I love the name, Book Report. I remember when I was younger and I didn't do my homework, I would say that my dog ate my book report. But this is really something, you really are a great Fed watcher, and your views have been lonely. Are you starting to be less lonely with 2018 rolling around, where every bear has really gone into hibernation? But no, you think 2018 still lonely?
It's still pretty lonely. I mean, I know 2018 is when it will start to matter, particularly just in January 2018. I mean, if you just look at the ECB and the Fed, the monthly purchases, if you net out the two of them, are going to go from about $60 billion a month down to $15 billion a month. On a 12-month run rate, you're talking about $500 billion of less money getting pumped into the markets or the financial system. So it really begins in January, and I would not be surprised, similar to the response in January, February 2016, after the Fed raised interest rates in December 2015. We saw that big sell in the first 2 months of 2016, that we get a similar replay. I mean, the market's obviously doing what it's going to do this year, and it'll probably continue to next year, but the liquidity spigot turns into more of a drip come January. And I have to believe it's going to matter.
Yeah, the last time it disproved the theory, so as January goes, so goes the rest of the year. Maybe this time it's different. I know it's outside your bailiwick, Peter, but are there any kind of geo things that, a lot of things that are happening, perhaps what's happening politically with Mueller, perhaps what's happening with decertifying the nuclear deal with Iran? And, I look at the first thing that President Trump did was go to Saudi Arabia and then Israel and then decertify the nuclear deal. Do you take any of these things into account, that sometimes these economic cycles coincide with geopolitical cycles? And is that just something that is on, the outside of the way you look at things?
I think it's more on the outside. I mean, everything you mentioned is certainly hugely important, but I think at the end of the day, markets are going to be driven by the economic fundamentals and monetary policy. So if those geopolitics impact the economy, impact monetary policy, then it will matter. But if it does not, the markets don't care for more than a couple of days. And
Right.
I think it'll be the Fed further tightening. It'll be the ECB dealing with getting out of QE. Even the Bank of Japan, I mean, they're in a subtle taper as they're buying less ETFs, they're buying less bonds. To me, that's going to be the biggest driver, more so than geopolitics, assuming with Mueller, for example, only if it affects tax reform will it matter, but it's unlikely to. So it's news, but I don't necessarily think it's market moving news.
All right, great interview, Peter. Once again, thank you so much
Thanks
for coming back. And people could follow you at P Bookbar, and that's spelled BOOCKBAR. And everyone take a look at the book report. Thanks again, Peter, for being with us. And let's get back together. Yeah, let's get back together in 2018 and see what's happening as the water begins to only drip out of the spigot.
Sounds good.
All right, Peter. Thank you very much. Bye-bye. And Face, that's it. Have a great day. We'll see everyone tomorrow. Good hunting the rest of the day. And remember, don't just count your pips, count your blessings, and get prepared for what Peter's talking about in 2018. It's only a few months away. You're very welcome, Luca. Okay, see you, buddy. So I'll see all my Trading Warrior brothers and sisters tomorrow. Enjoy the rest of your day. Remember, money comes and goes. Time is gone forever. Make it count. Adios. You're welcome, Kev.